Hello, my name is Lucas, and I'm going to give you today an overview about the topic economic cycle. Are you in the same situation like me? The finals are getting closer and closer, and you're supposed to learn the whole subject material of 3 years in barely 1 week? Well, this video can tell you the meaning of life, but a lot about the economic cycle. I guess that's pretty close. I arranged the structure of this video as follows. First, I talk about the gross domestic product or GDP. Then I show you what the multiplier effect is. Later on, I give you an overview about the economic cycle. After that, I show you what the government can do to influence the economic cycle, like demand and the supply side policies. Okay, let's start. What is the gross domestic product? Well, it sounds quite complicated, right? But actually, it's pretty easy. The GDP is a measure commonly used to calculate the economic performance of a whole country or region and to make international comparisons. It can basically be computed on two sides, as aggregate supply method or aggregate demand method. The aggregate supply method or GDP output method is basically all goods and services produced in an economy within a year. This is then expressed in a certain figure. On the other hand, the aggregate demand method is focusing on the demand. Well, what a surprise! The aggregate demand curve shows how much money the private households are willing to spend, how much investment is going on in a business, how big the government's expenditure is, and how much net exports the country makes within a year. I should show you an example of GDP by comparing two different countries. Let's have a look at the well-developed and wealthy country like Germany and compare it to a still developing country like Ethiopia. We see that the GDP of 2014 of Ethiopia was $132 billion, and the one from Germany was $3.47 trillion. So you see that the GDP can tell a lot about the country's economy as well as the country's condition. Now we need to distinguish between nominal and real GDP. Real GDP is actually just the nominal GDP minus inflation of a country within a year. Now we go to the multiplier effect. The GDP can be influenced by different measures undertaken by the government. The multiplier effect occurs when an initial money injection into the economy causes a bigger final increase in national income. I can explain it best with an example. Let's say Switzerland puts 1 billion francs into the tourism sector. This money will be used to employ more people in this market. These employees get higher wages. This will lead them to spend more on, let's say, luxury stuff. That money then again becomes someone's income. With every economic activity, some of the money is not going to be used because people pay taxes or save some of this money for later. This process goes on until all money is eventually used. This money will cause economic activity, which is positive for the GDP. However, the multiplier effect can distort the economic cycle. Let's have a look at the economic cycle graph, which defines how well a country's economy is doing. It is a curve which goes by time through different economic stages. The government can influence the graph, but eventually the graph will always have a certain kind of continuity with highs and lows. The graph is measured in GDP figures. With the help of indicators, we can just about assess the economic situation of a country's economy. The indicators that define the situation the best are interest rates, levels of employment, consumer spending, prices, saving behavior, wages, and profit situation. In the upswing, these mentioned factors, except the saving behavior, will increase. In a boom, those factors will reach an ultimate high. Mostly there's inflation as well. The economy will eventually reach the point where a downturn begins. This downturn, with a decrease of all named factors except the saving behavior, will lead to a recession, where the saving behavior is exceptionally high. A deflation is also likely to happen. Sometimes, if the economy doesn't recover from a recession, it will even result into a depression, which would be the worst case scenario. For example, if a company is not able to have a full employment because they haven't got money to get more labor forces, because the demand for goods is pretty low, there is the possibility to apply the demand-side policy, firstly introduced by John Keynes. The most important property of the demand-side policy is that government spending is a vital necessity for the economy to run. The money output program should increase demand and therefore make a company to take more risks, like employing more people. However, some critics claim the policy to have time lags after the implementation, high national debts, and difficulties to regain the spent money, which results into spending cuts. The supply-side policy has a different approach. The supply-side policy, introduced by Arthur Laffer, concentrates itself on the supply aspect. This policy tries to make the economy more attractive through deregulation, tax reduction for companies, and privatization should the economy have cheaper working conditions and production. Normally, the companies become more willing to take risks. Also, the supply-side policy has its weaknesses. It disregards the demand. This means that if you have a lot of supply, it won't benefit you if there isn't any demand. Furthermore, there are two problems with the implementation of those deregulations. Firstly, it takes a lot of time to put them through, and secondly, if the deregulations are implemented, it does mean that companies will automatically be more willing to take risks. Well, that's it. Now you have a good overview about the economic cycle. I hope you enjoyed the video and learned something. Please leave a like or a subscription if you like my video and stay tuned for more content in the future. Bye!